Cool. All right. So welcome everybody to my first workshop. It's the basics of fundamental analysis. So I'll be focusing more on the price to earnings ratio in this fundamentals workshop. So let's get started. So what exactly is fundamental analysis? Fundamental analysis, there's two things actually I would try to go more into depth with. It is fundamental analysis is looking at the financials, like the financial statements, and determining whether or not this company is like a buy or not a buy. You're not really looking at the historical stock prices as much. That's more of technical analysis. So hopefully I can zoom in. This is really tiny for me, honestly. There we go. Okay. So fundamental analysis is more focused on finding the value of a stock. Technical analysis is more at looking at the trend patterns of how the price moves, the stock price moves. So fundamental analysis, you look more into the financial statements and find out when, what to buy. And then technical analysis is more telling you when exactly to buy. And another key factor in the differences is fundamental analysis is more for long-term investing. Technical analysis, it can be used for both long-term and short-term. Oh, there we go. Okay. And right here, you can see, let me move it over here. Here's what the indicators you use for finding out technical analysis and the indicators for fundamental analysis. You can find all of these using the income statement. So let's move on to the next slide. So fundamental analysis, like what you're trying to do is gather insights, information, maybe from the economy, financial statements, from the company itself to derive an intrinsic value for the company. That is what fundamental analysts do. The pros and there's two areas in fundamental analysis. So there is qualitative analysis, which let's see if it, and quantitative analysis. So for qualitative analysis, fundamentals, they can't be quantified. So examples, technology disruption. So let's say, I want to buy a oil company, and let's say this other company, this competitor, they created a new product, let's call it like element X, and it does everything that oil does, but it does not cause emissions. That is technology disruption. That's disrupting that industry, that company's own product. Economic moat, this is something that Warren Buffett, he usually says. It's, for example, Coca-Cola. It has a very large economic moat. What that means is they've been in business for a long time. The only two products are soda and Coke. And if you're a competitor or you're trying to like start up in that same business, it's pretty damn hard to, try to battle Coca-Cola. Economic moat just basically means, that financial standing, that branding that company has. That's something you can't really quantify with a number exactly. It's more like a reputation. These are all factors you can't quantify. The next one is management. So for management, it would be like, for example, a new CEO takes in and let's say he does some layoffs, he tries to cut costs, improve operations, and then, you can't really quantify those kind of actions within a company. There's no number you can quantify when those kind of things come into place. And then we'll go to quantitative analysis, which is numbers that can be quantified. So when I was talking about the financial statements, assets, liabilities, earnings, revenues, cash flows, and the ratios that you can get from the financial statements, those are all numbers that you can they're quantified. You can make a pattern historically and try to compare it with the stock price. They're numbers that that's pretty much what quantitative means. So the pros and the cons I want to give to qualitative analysis is you have a good sense of what's going on with the company, You can gain insights of what many investors and traders see, and eventually you do eventually make a profit. The downside to it is it's difficult. I'll be honest with that, right? Like, because there's just so much information out there, it can it can just be so hard to determine like what you should focus on and what's noise in the markets. So that's called, what is it called? Like analysis paralysis. That's the name of it. You just have so much information that you're taking in that you just don't know what exactly to go for. And then the pros and cons of quantitative analysis is, well, the pro is it can be quantified. You can use quantified data and backtest and see whether the data gives you a market being returned in the long run. For example, right, it's proven that value stocks that have a low price to book value, they tend to outperform the markets. I don't really need to see insights. I just need raw data and see what works and what doesn't work with quantitative analysis. So how do I gauge whether a stock is expensive or cheap? By using something called a multiple, we can figure out how we're paying for a stock's underlying business and how it has changed over time. So let me go more into depth on that. So a multiple, for example, is the PE ratio. So here's a little screenshot of when I Google search the Apple stock. So you can see right here the open price, the market capitalization, which is like the value of all the stocks for Apple, dividend yield, blah blah blah. But let's focus on the PE ratio. So again, a multiple is a ratio that compares the stock's price to a fundamental number. Generally speaking, the higher the multiple, the more expensive the stock is considered. So there's hundreds of multiples that investors can use, such as EV to EBITDA, price to book value, EV to sales, etc. Some of the multiples are industry specific, whereas others are more broad in nature, and each carries a different implication. And the PE ratio, which stands for price to earnings ratio, is one of the more straightforward and popular multiples that investors use. It's the stock price divided by the earnings per share. So, hi Sam, welcome to the chat. We're kind of like already started, but glad you came out. I also I'm making a recording right now too, so you can join later. If you can turn off your mic, that'd be great too. Thank you. So going back to an example, let's go on an example. So if the YIT Corporation had $1 million shares outstanding for $30 in stock, and last year they made net income of 2 million, that gets us a PE ratio of 15. It basically shows how to say, the PE ratio is known as a trailing PE because you're looking at the historical data, because we're calculating using historical information, and it's one of the easiest multiples to understand. It basically shows how an investor is willing to pay per dollar of a company's profit. That's pretty much what PE ratio is. So for the YIT Corporation, we're paying, again, we're paying a price equal to 15 times our share of the company's profit. Let's go next. Nice. Oh, there we go. So going back when I mentioned trailing PE, it helps conceptualize how much we're paying for a stock. However, it is backwards looking. So that is a flaw. So a flaw to this is, many believe the markets are forward looking. If a company is expected to release like a new product, enter a new market, or improve its operations in the future, then a company will likely trade higher. Something that the PE ratio wouldn't take into account using the past earnings to explain this. Because of this, many investors prefer to use what is known as a forward multiple. In this case, the forward PE. So the forward PE, the formula would be it divides a stock's price by how much the company is expected to make in the next year. So an example of this would be let's say the net income now, we expect it to be 2.5 million instead of 2 million. So the forward PE ratio would be smaller. It would be 12. It will be 12 times. So there is a flaw to this as well. relies on assumptions, relies on forecasts, based on news, what kind of insights you get from the market, or what kind of information you might find out that could affect that net income. But still, this can help gauge the value of a stock and how much investors are paying for a company's expected profit. So there we go. So what exactly do these numbers mean? So our forward PE ratio is 12 times. Well, what is it? Yeah, like what like what does that mean? Like it's just a number. Not a whole lot. So you see, multiples are a relative measure. Sure, understanding how it'll take your stock to pay for itself is useful, but to understand whether the level is attractive or not, we've got to compare it to other multiples. We could, for example, compare the forward PE ratio to YIC's historical ratios. Um, there you go. YIC's historical ratios to see how it's changed over time, to see whether investors are valuing the company higher or lower than normal. We could invest it to the long-term average of those historicals or to its competitors as well. So let's go into the historicals. So if a company's earnings are increasing on the left side, was my mouse, okay. If companies' earnings are increasing, but its stock price is falling, it would mean that the multiple has contracted and investors don't value the profitability of the firm as much as they used to. Alternatively, if earnings are falling, but the price has well, and the price has risen, well, the multiple has expanded, meaning people are paying more for less profit. So going to long-term average. So we can compare the PE ratio, the PE multiple to the stock's long-term average to see whether the margin is smaller or larger than normal. If the stock's 10-year average is 15, for example, we can assume that the stock's PE, like YIC Corporation's PE, is temporarily cheaper than normal, and we may want to buy. If we pick up the stock and the multiple later expands back to that in the long term, let me see if there we go. And it later expands to the long term. What was I? Oh my goodness. Expense to the long term average, then we can return even if that company's earnings are flat. A key assumption here though is that the multiple is supposed to revert back to its average over time. While this doesn't always hold true, investors sometimes look for extreme variations from the mean with belief that short-term volatility in a stock's multiple would eventually change over time. So how do I say it? Which it could be because it could be caused because of a bad press release or negative near-term headwind, which usually would subside over time. So awesome. So we see if a company is trading below the multiple level. If we see that, we should buy, right? Well, still not quite. Sure, understanding whether a stock stands compared to the past is great, but you need to be comparing other values, other stocks in the same industry. So when we look at competitors, as great as it honestly would be to have like a number one basis in making investment decisions, it typically isn't that simple. Multiples are limited in the amount of insight they provide. With the PE multiple, we aren't taking into account of like the growth rate and other factors. But when we look at the competitors right here, we can see, like, for example, the YIC's PE ratio is a lot higher than alphas and PGs, lower than PGs, but it is above the peer averages. So what we still it's still a broad number. You still got to understand what these numbers mean. So just because sure, that like our number compared to the peer average may seem expensive, but if YIC is also if we're also putting in account some other factors such as like growing earnings, which the PE ratio does not really calculate, the multiple can be justified for that higher PE ratio. So this is why high growth companies like tech companies, tend to have a lot higher multiple than stocks in slower moving areas like the utilities companies. One of the other ends of the spectrum is of the PE ratio compared to its peers. It doesn't mean like it's a good buy. Um, the multiple could be justified by the company's fundamental. If the company's fundamentals have been deteriorating, a lower stock's PE may reflect a justified devaluation of a stock. That's the thing with multiples. They're pretty meaningless without context if you don't understand like the industry or what exactly is going on within the company. But once you do understand it and you can see like that relationship with how it's changing compared to its competitors, then yeah, you have an edge in knowing whether or not you're making the right decision to buy or sell or short a stock. So, while multiples can certainly help you make an investment decision, you need to ensure you have a good understanding of a firm's operation and its future prospects, not just the stock's multiples. So, like Warren Buffett says, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. What I mean by that is, let's say, for example, I want to buy a steak that costs $3 a pound, like $3 a pound, compared to another steak that costs $12 a pound. Which one would most people choose? They would choose that one that costs $3 a pound because it's cheap. But when you go home, you find out, oh, it's spoiled. That's what I mean by deteriorating companies. Is yeah, the stock looks really cheap, but you don't know if it's going to get even cheaper. You don't know if it's going to go pop back up in value. You got to look at the other fundamentals, such as the earnings and not just the stock value. That's why we do fundamental analysis, is to really understand why exactly this price is moving. If they're looking at the financial statements. Um, with that kind of wraps up like this section of the workshop. I know this workshop's really cheap. You guys expected like an hour or something, but I wanted to really focus in on one specific fundamental, which is the price to earnings ratio. Reason why is because it's one of the most popular indicators that people use. Even it's like one of the main ones. Even Google puts it on there for a reason. A lot of investors, they look at that for a reason, and it's for good reason. Do I have